All right, let's jump right into our example. So like I mentioned, cash flow forecast template available on my website. Download it, make it a copy, insert the name of your business. If you were doing this on your own, I would say, like it implies here, start with the first tab, which gives general instructions and an overview as to the information you're going to input into the following tabs. You can do a cash flow forecast for any finite period of time. If you want to do a 24-month forecast, that is totally up to you, right? You can use the information and add additional columns into the worksheet. But really, we're going to work through just the 12-month because I think it does serve a good example of really the importance of timing as we talk through this stuff. So I've broken out kind of the most common inflows and outflows, but you can always add additional lines in here if you have other stuff that you need to add in that's relevant. And if you track your business at a very granular level and you've got 15 different sources of income, add them in. It's all formulaic. It should work. But the first thing you're going to want to start with right here is at the top. So it's always inputting the current month and your current bank account balance. So I'm just going to start throwing some numbers in there so you guys can see the impact at the end. Let's say I have $7,000 in the bank today. So right now, because I have no inflows and outflows for the 12-month forecast, you're going to see, right, the balance just kind of ran across here. But then let's start to put in some activity. So I am going to put in that I have service income that comes in, let's say it's $3,000, but that only comes in every other month. So I'm going to put that in every other month. It is not exactly an every month recurring revenue source, right? But periodically, the services I provide are every other month to the specific client that I have. Now, course income. This one, let's say, is a recurring $500 a month. Right, so we're going to copy that over and we're going to drag it across there. Okay, now I have that was group services income. Course income, let's say, is $1,000, but that is only, and again, let's say that's like a live course where I only do that every 6 months. So 1, 2, 3, 4, 5, but then February, 1, 2, 3, 4, another one in July. Okay. And then product income, let's say that's $700. And then maybe I'm going to launch a new product in October, and I'm expecting that's going to bring in another $200. So I'm going to say in those months it's $900. Then again in January, I decide I'm going to launch another one. So again, these are all like plans based on what I'm expecting to do in my business. And those other lines where I just was using flat numbers across, you can modify based on what your goals and your plans are from a revenue perspective. Or let's say, I'm planning to upcharge and change my prices, right? Whether it's new products or changes in prices, as soon as information is available, incorporate it here because it will give you a more accurate picture as to what your cash balance is going to be at any point in time. And we'll get to that same concept when we get to expenses as well. So just throwing some numbers in here. All right, so it looks like, right, we have varying inflows across the months, right? So we have to be cognizant of that, where let's say I check my bank account balance as of the end of August, I am likely going to have a higher balance, but then I go into September and my inflows are only $1,200, right? So we have to make sure enough of this cash is going to hold us for the expenses we're going to incur in the lower months from an inflow perspective. Okay, let's keep that in mind. That will help drive really what the action items are and where the decisions and suggestions can come in from just a habit perspective or how you interact with your vendors, things like that. So let's talk about cost of goods and then all the other fun expense pieces that we may have as part of our business. So we had, 52. So let's say we have margins that are, I don't know, 30%. So I just did an estimate, guys. All I did was, okay, my profit typically after I take out the cost of service or cost of goods sold, again, cost directly attributable to my product or services that I am selling. So I just did a quick, and you can hard code this. It doesn't have to be a formula. And you can use your historical information, guys. Look at your P&L and say, okay, typically my cost of sales is X, right? So when you're putting this together, it doesn't have to be a guessing game. Use information you have based on how you have performed, how you have charged your clients, what you've incurred from an expense perspective, what contracts you have in place of things you're going to incur. So be as precise as you can, be as up to date as you can, and use real information. Again, I understand I am just plugging some random stuff in here, but obviously as it relates to your business, you have information. Go look at your bank statement if that's what you need to do to figure out what you paid X vendor for whatever point in time if you don't have good books and records. Even if you don't have a set of financial statements that are clean and ready to go, you can still go through this exercise and be able to understand your cash flow forecast. So I'm going to just drag this across. Okay. Now we can already see you have the net change in your balance down here. And it is, again, still in an inflow, and it calculates your cash at the end of the month, right? As you can see, it does it each period. So we'll continue on with our expenses and see where we land. So we've got contractors. Let's say, again, this is a contract basis. So we pay them the same, let's say fixed amount each month, and that's $300. So again, dragging it across. You can do the same thing with these other expenses, right? So payroll, marketing, insurance. Insurance is when I just want to take a pause at for a second, because I've seen it where, right, insurance sometimes can be due twice a year, annually, monthly. Your billing schedule with the insurance company, just make sure you're incorporating that, because maybe I pay my insurance every, I don't know, January, and it's in like a lump sum $10,000. Right? But that's only once a year. Okay, great. Now I don't have that any other month, but look at my cash flow here, right? You see the impact of a big outflow on your balance at that point in time. So if it were me, right, I'm looking at my bank account balance that month, and I'm like, oh my God, where is all my cash? What happened, right? Oh, wait, hang on a second. This month we had that one thing that went out the door that, again, is supposed to cover the whole year, but the cash went in that specific month. So again, the timing of when you guys are building this out is important as to when you're going to be paying this stuff out. Not everything is a recurring flat thing every month, right? And you can play with this, right? Let's say marketing. I spend, I don't know, $1,500 on it. And I say, you know what, but I'm really thinking I am going to spend more. Maybe in the month of November, I'm planning to spend $2,000 because I have something specific that I want to promote, because we talked about new product launches, right? So just think about the impact of plans, decisions. It's not just like, let me look at my historical and throw it in here. Like, incorporate where you would like to go so you can see the impact. But if for some reason that's taking your cash flow way too low and you're uncomfortable with the answer here, then maybe it's, well, let's talk about what the timing is. Maybe we can incur these expenses at a different point in time and pay the cash out at a different time. Or maybe I just don't do that right now, right? Maybe I'm prioritizing investing in something else. So make sure to include any other items in here that you might not have. I mentioned owner's pay during the intro, right? One of the key differences between your income statement and your cash flow forecast is owner's pay, right? This is how much money I need to pull out of the business. What am I getting paid that I typically don't see on the face of my P&L if you're reviewing your other financial statements? So making sure to incorporate those costs here. And at the end of the day, again, you're going to see what the end of the cash balance is. So The other thing I would just make sure to encourage, and I know I said you can incorporate other line items, the importance of capturing everything here. And I'm going to give just like a quick example, and vehicle costs is what kind of triggered me to say this, is let's say in your business you have a fleet of cars because you're a service-based business and your employees drive these cars to service calls. The maintenance costs relating to those, right? So like things are going to go wrong. A car is going to break down. You need to get a tow truck. You're going to need to fix things. Incorporate some of the things you may not think about in terms of daily operations, right? Like make sure you're thinking through really what can go in here. I always think about like my personal budget, my personal cash flow forecast, right? And like how many different expenses I have and things that come up that I want to budget for to make sure that when I'm looking at my balance, I haven't not thought about it. And I'm like, where is this money going to come from, right? So be as comprehensive as you can. Ask yourself the right questions about your spending habits, about the things that you would like to spend money on, the things that could go wrong, and try incorporate a certain element of being conservative with this, right? The more cost you add into it, the easier it's going to be to figure out, well, hey, do I have an opportunity here to potentially negotiate? And when I say that, it could be even something as simple as renegotiating payment terms of timing with a vendor, right? That insurance payment. If you called your insurance company and said, hey, listen, can we actually split this out into monthly payments, or can we do a twice a year payment, or can I have it where it's paid in November, even though that may overlap from a coverage period perspective? Maybe it's earlier, right? So like I have the cash, let me pay it then, because again, when you're looking at the cash inflows and outflows, the importance of how they kind of interplay is totally underrated. So that's why this document does such a nice job of really giving you a picture as to where you're going to be from a balance perspective. And as we say, cash is king. So I hope this was digestible. I hope it was simple enough. If you guys have any specific questions, feel free to DM me. Feel free to reach out via the contact form on my website because I'd love to answer your questions.